It's still mostly rumors, but the Ukrainians invaded across the border in Russia and apparently have gotten hold of a pipeline from a transport station in Sudzha. Now, that's the last station before Gazprom's main pipeline enters Ukraine. Russia has basically stopped all pipeline gas flows into Europe save for this one pipeline. So if anything happens to these flows, that would be the last link of Russian gas entering over the land borders into Europe. It's a small amount, though. It's about 3 to 5% of Europe's total gas supply. It mostly serves Austria and Slovenia. So there's not a huge risk of any kind of widespread shortages. And for right now, the gas flows seem to remain normal. Ukraine said that basically if it wanted to stop the flows, it could have done so without taking over this pipeline substation, and so they're planning on keeping it running. We have not heard anything from Gazprom on whether they want to keep the station running to keep making money, or if they're going to try to turn off the spigot. And so that's why you're seeing a little bit of extra risk on with futures prices jumping up about 3.5–4% to the highest level of this year.
Dan, what is your understanding right now of the sensitivity then of European gas markets to this kind of risk, and where inventories stand as we get to this mid-year point here in Europe?
Yeah, so right now Europe's actually pretty well supplied. Its inventories are up in the mid to high 80% range, about 10 percentage points higher than they normally are this time of year. The big problem is that it's been really hot, both in Europe and also in Asia, which has been driving a lot of gas demand across the world. You have places like Taiwan and India, which have set records or multi-year highs in LNG imports. And so Europe's actually seen a decrease in LNG imports in recent months as more of the product has been shipped over to Asia. That means that if this pipeline has an outage and Europe needs to fill up its supply, it's going to have to outbid these Asian buyers for it. And so that's going to obviously add to costs, and that's why you're seeing traders try to get out ahead of that just in case.
And Dan, you talk about Asia. You're sitting there in Beijing, of course, the Chinese capital. What is your sense of the demand picture out of China? All these concerns, of course, about the relative softness of the Chinese economy right now, the inability of officials and policymakers there to turn things around. When it comes to that energy consumption need of that major energy importer, what is our understanding of where that picture is at?
Yeah, it's a really complicated picture right now, Tom. We're seeing a sort of different pressure points across different commodities here. But on the energy side, fuel like oil and gas has been a little bit softer. Power demand is going really strong this year because it's been hot. There's been air conditioning needs. You're seeing new data centers. You're seeing a lot of like EVs hitting the road, and so power consumption is running really, really strong. But gas outside of the power sector has been relatively weak because there's been less industrial demand as the property market crisis continues to unfold. And we're starting to see oil demand decline a little bit and imports drop, partly because EVs are starting to crowd out gasoline cars on parts of the country and reduce gasoline demand, and partly because diesel is being hurt by the lack of industrial activity and the lack of construction.